the ever-shifting tides of the global economy, nations must navigate with a steady hand and a long-term outlook. Such is the approach Hungary's central bank seems intent on taking as it calibrates monetary policy amidst evolving inflation dynamics. As bright sunlight streamed through the windows of a Budapest cafe, patrons sipped espressos and digested the latest economic news over flaky pastries. The kindly owner, Zsuzsa, explained how she and many of her customers closely follow the monetary decisions that could impact their businesses and household budgets. "We know high inflation can be harmful if left unchecked," she said warmly, "but we also don't want overly aggressive rate hikes that could choke off the recovery. It's a delicate balancing act that the National Bank of Hungary appears to be treading carefully." After an unexpectedly sharp slowdown in inflation last month, with the annual consumer price index falling within the central bank's target range, policymakers seem poised to extend an easing cycle with another quarter-point rate cut at their meeting this week, according to a Bloomberg survey of economists. This measured approach echoes the sentiments expressed last week by Deputy Governor Barnabas Vorag. With lingering inflation risks still on the radar, he reiterated calls for cautious, patient monetary policy adjustments. At the same time, Vorag noted the improving global backdrop and the benign inflation data as potential catalysts for further gradual rate cuts, perhaps on as many as 3 occasions this year. The visibility of central bankers often puts them in an isolating spotlight, armchair critics questioning their every move. But as I wandered the stately buildings and winding streets of the Hungarian capital, it was clear many citizens understand the high-stakes balancing act their monetary authorities face. At an outdoor cafe near the imposing Hungarian parliament, a group of young professionals discussed the nuances over glasses of bright red cherry liquor. Overreacting with aggressive rate hikes could be just as damaging as letting inflation get out of control, offered David, an economic analyst at a local firm. His friend Esther nodded. The gradual, data-driven approach seems prudent, even if it requires some patience. Of course, that patience is aided by the resilient forint, the local currency, which has rallied to its highest level against the euro since early June. A stronger exchange rate can ease imported inflationary pressures, providing more latitude for central bankers to let economic conditions firm up organically. As I reflected on these conversations, it struck me that while monetary policy can sometimes seem like an effete sport of econometric models and institutional groupthink, the human impacts are starkly real. Overly aggressive rate hiking could imperil the fledgling COVID recovery, while letting inflation rage unchecked could punish those least able to absorb rising living costs. The National Bank of Hungary seems to appreciate these weighty dynamics, pragmatically downshifting its pace of rate cuts from the start of this year while still gradually removing accommodation as conditions allow. It's a nuanced approach focused more on avoiding policy whiplash than on scoring showy headlines. In an era of social media thunderclaps and partisan score settling, this quiet, judicious discipline is admirable. As the world economy continues gyrating between inflationary flare-ups and disinflationary pressures, Hungary's central bankers are taking a path that seeks to avoid reckless overcorrections in either direction. The human fabric of parents stretching paychecks, businesses navigating COVID uncertainties, and ordinary people simply hoping for a semblance of economic stability is ultimately what's at stake. From the cafes of Budapest to the gilded halls of power, the through line is a widely shared desire for sustainable growth and a monetary policy that recognizes the vicissitudes of the moment while keeping a steady hand on the tiller. In a world plagued by conflict, polarization, and the endless chase for social media serotonin hits, Hungary's monetary patient path may not captivate the exhibitionist economist crowd. But to bakery owners hoping to pass down a thriving legacy, young professionals striving for upward mobility, and the broader populace yearning for economic ballast, this nuanced approach carries its own quiet wisdom. As the sun dipped below Buda's rolling hills, I couldn't help but feel that if more institutions embraced this ethos of prudence, humility, and long-termism, the human condition might be a bit more resilient in the face of incessant turmoil. For in the end, aren't we all merely seekers of stability, hoping the cross-currents of history might grant a measure of economic equanimity?